Hey everyone, I'm so excited about today's episode, but first want to let you know that this show is made possible by Fortune Builders. I also want to take a minute to invite you guys to an amazing opportunity to learn from some of the top experts in the real estate industry about how to get started in real estate or scale an existing business to the next level. Fortune Builders is hosting a one-day webinar to help you learn about real estate investing in today's market. So throughout the show, if you feel like you're ready to get started, go to fortunebuildershow.com to register. Again, that's fortunebuildershow.com to register. If you're watching on YouTube or Facebook, you'll find a link right below the show so you can get there that way as well. And please remember that the content of this show and every show is for educational purposes only. Myself or our guests are not going to be providing any legal, financial, or professional advice. If we share specific results, they are attributed to an individual or a business, and we can't guarantee the results will happen for you, those earnings or the income will match those figures. The bottom line is there's always risk when investing in real estate. You can make a lot of money or you can lose a lot of money, and it's hard work. But that doesn't mean we can't have fun doing it. So let's get into today's episode.
From a team that has $1 billion in real estate investment experience. A show to help you learn the strategies and systems it takes to get started investing in real estate. This is the Fortune Builders Real Estate Investing Show.
Hey everyone, Jeff Rakowski here, and welcome as always to this week's episode of the Fortune Builders Real Estate Investing Show. I am here with the man, the myth, the legend.
Oh, you're too kind.
Yeah, they told me I use that too generically, like for everybody, but I purposely have not used it in over a month just for you, Jeff.
Thank you, Jeff.
But it's good to have you here, man.
Good to be here.
It's always a better show when you're in the mix.
Thank you.
So it's definitely great to have you here, and we're going to be getting into hard money today, JD.
Yes.
Hard money.
Stiff, firm, rigid money.
Yes. Dense.
Dense.
Dense. As we were saying. So why don't we just make hard money the word of the week this week, since we're going to be unpacking it. So actually, during the show, we're going to give you multiple definitions of hard money.
More than one?
More than one. Yeah. Diversity, JD. We're all about diversity here. Not just one definition. We're going to give you multiple ones. But we actually, JD and I before the show, we learned some new definitions. But we'll tell you that during the show. But in the context of real estate, hard money is basically, it's asset-based lending, where there are lenders out there that want to loan money when it is backed by a hard asset. Mm-hmm. To me, that's what I think of. Real estate is a hard asset.
Absolutely.
You're not investing, in a stock market. You're investing in something tangible. So hard money lenders, when they loan the money to us as investors, they are able to secure that money that they loaned on the piece of real estate via a lien. We're going to unpack all of that. But just think hard money, hard asset. I think that's the simplest way of describing it. But let's get into the show.
Sounds
you ready?
Good. I'm ready to go.
All right. Well, first of all, man, a lot's been going on in the world since we talked last. We had not this past weekend, but Super Bowl.
It was a great game.
It wasn't it?
It was a really good game. Awesome halftime show.
Oh, legendary.
For sure. I mean, really great halftime show. The game was great too. Fun to watch.
Yeah. I saw this meme on Facebook, and it was like it basically said all 40-year-olds during the halftime show turned into gangster rappers. And I don't know about you, but the party I was at when Eminem came out, it was just like the whole room is just going
iconic songs.
Oh,
it was fun to watch, and I mean, in my recent recollection, probably the best. I mean, Prince was awesome. I remember
Prince was great.
He did Purple Rain, and
it started raining.
I mean, you couldn't even draw that up any better.
I know you couldn't.
But came down to the wire, and the team with the most points won at the end, as I predicted.
Sound like your brother now.
Hey, I don't know everything, but I know that at the end of a game, the team that has the most points
Yeah.
probably going to be the winner.
Yeah, that's profound.
Right?
That is
for those
very
of you
profound.
listening, watching, write that down. That's a direct quote from J.D. Asajan.
There you go. There you go. So you enjoyed the halftime show. What type of music are you into? I know Led Zeppelin, some of the classic stuff you into.
I listen to a lot of rock music, a lot of
Yeah.
like metal music, but I also listen to, the hip hop and rap.
Yeah.
Those artists I grew up on, right? Dr. Dre, Eminem after him, Snoop
Yeah.
Dogg.
Oh, so
Kendrick
good.
Lamar was great too.
Yeah, he was
He's
good. He was
awesome.
good.
But, if I'm putting in music, I'm probably putting in like either Metallica or Incubus or Led Zeppelin or
good choices. Good choices.
Sometimes I'll pop in the Police. I like to listen to some old school stuff too. So
I like
I'm
it.
a diverse individual, Jeff, when it comes to music, and I would say life too.
Yeah. There's that word again.
But we definitely got a good show. I mean, we've talked about acquiring deals before on the show, and I know we will again. But as well as I do that the number one or two question we get, between how to find deals, if it's not first or second, is how do you fund them?
Yeah.
Where do you get the money? How do you get more money? Because it can obviously bottleneck your business growth if you don't know how to.
100%.
So it's a good timely episode to talk about this and really break down the most advantageous, maybe not advantageous, but the most readily available source of capital and how to use it.
Yeah, that
real estate.
That's a great way of describing it. I mean, I was blown away when I hooked up with you guys in 2007 and just started learning this world of investing and how much capital is available, different types of capital, I should say. Specifically, I mean, before that, my context was you buy a house, you go to a Bank of America, you go to a Wells Fargo, you get a traditional loan, right? Mm-hmm. And I remember actually finding one of the first deals I wanted to flip and walking into Milford Bank in Devon, Connecticut. And, and they basically laughed me out the door because they don't offer that type of financing, right? But you guys opened me up to this whole other world of asset-based financing, which isn't just specific to hard money, private money lenders, things like that. But why don't we just start there with that concept? And, why is the idea of asset-based lending, so important and so attractive to a brand new investor?
Yeah, well, I can speak from personal experience. When we started out, as is the case for a lot of people, you don't have a strong financial, portfolio at that point. Some people do, but people, for asset-based lending, like we're talking about here, it's driven significantly more by the asset that the lender is putting money against or securing the money against. So if someone doesn't have a ton of money in the bank or they haven't built up their balance sheet yet, the lender in this type of financing is going to look more at the asset. Now they are going to, as they are going to look at your bank statements and they're going to look at your finances, but they're going to weight their decision more on the actual deal that you're looking to borrow the money against, which is great. I mean, a lot of people that I've met over the years sometimes have stifled or stopped themselves from getting ahead in real estate because they don't have money sitting in the bank, or they can't buy something cash, or they don't know other sources of capital. Yeah. And hard money is one of those things that will open up a lot of doors. So, it comes down to the lender is going to look at the asset as primarily before and as they're looking at the borrower at the same time.
True or false statement, JD? So you find a money-making deal. Okay. The money will attract itself to that deal.
I would say absolutely true.
Probably the least of your worries.
Yes.
Yeah, and I remember you guys always used to say that when I was getting started. I'm like, what the heck are these guys talking about? Like, I'm broke, right? I'm broke right now. Like, how am I going to attract money to you? But it's exactly what you said. I mean, hard money lenders will look at our personal financials, and I always use myself as an example when I'm talking, especially to new investors, because 6 months out of bankruptcy, living at my dad's house, getting a good deal under contract. I had 3 different hard money lenders, almost, debating, and really trying to give me better terms to loan the money. And I remember sitting there at the time thinking, I don't even know if I'd loan money to myself right now, and having, and being in my early 20s, and we're talking, I don't know, it was like $350,000, at the time. But you're absolutely right, and that should give. That should give, new investors great confidence.
100%. Yeah. Because, put yourself in the shoes of a hard money lender. Their job is to get money out and deployed against hard assets like real estate. So they're they're looking for the investors like you and I, or those of us that are listening and watching the show, to be able to secure that money against, because that's how they make money. That's how they turn capital. And at the end of the day, if that lender is disciplined and lending money the right way, doing their fundamentals, the worst case scenario is they take the asset back, and in some cases probably can make more money than they would have on just the loan.
Yeah.
So, it is a mindset shift, because I also, like you just described, when we started out, we don't have an experience yet. We haven't done a bunch of deals. We haven't done any deals. We don't have a bunch of money in the bank. Who is going to lend us money?
Yeah.
But you're right. When you know what you're looking for, who the type of players that loan this kind of money, they'll be lining up at your door for your next good deal.
Yeah. They really will. I mean, you guys always said it, but when it actually happened to me in reality, my mind was blown.
Yep.
But yeah, but the key point that you make is, I mean, that's their business. They are out there looking, really for us. So why don't we start by just helping the audience and just giving some tips around where do we find them?
Yeah.
I mean, as you're starting a real estate business or investing, we want to, to me, the most important thing is finding the deal, but we do want to work on getting some money lined up.
Sure.
So somebody, what would your advice be for somebody looking up to set up those relationships?
Yeah, well, the way that we started is good old-fashioned networking, going to places where those types of lenders may be looking for prospective customers.
Yep.
Whether it's a real estate investment meetup, those kinds of events. I mean, when we started out, the internet wasn't as robust as it is now. You can go online and just Google or search for hard money. If you know other investors in your marketplace that are borrowing money, you ask them too. So you knock on every door. I mean, I would start with the internet because that's the lowest hanging fruit.
Sure.
A lot of hard money lenders will advertise or have their website there. Then start plugging into the investing community in your local market and talk to other investors. And between those sources, if you're consistent with them, you're going to find a list of 2, 3, 4, 5 local lenders, and there's national lenders as well. And I would also suggest that when you find what you consider to be a good hard money lender, you don't stop there. You want to keep marketing for lenders just like you market for deals, or just like you market for contractors.
Yeah.
So it's part of your daily or weekly routine is to search for additional sources of capital.
Agreed. I mean, I think that if someone asked me the question, I'd say exactly the same thing. Connect with the local investors, real groups. My first hard money lender you referred me to is Sunrise Financial.
Yeah.
I don't know. Are they still in business? I don't even know. I haven't dealt with them in so many years.
It's been a long time for me too. But you're a classic example where you started networking and asking. In that case, us, and we referred. So that's where you start.
Yeah, absolutely.
So,
but yeah, they're out there looking for us. I mean, I always think finding. I mean, there's national hard money lenders, as you just said, which are good, which are valuable. I always recommend also, in addition to that, finding somebody in your local market, because I learned there's a lot more benefits, to the relationship outside of just the money.
Yes.
And I deal, I'm sure you do with too, a lot of students. Oh, that hard money's nice, but I already have, I have cheaper capital, so I don't need that relationship.
Until you need it. Until you have more deals than your other capital source can fund.
Yeah, exactly. And I think this is an important principle. I'm sure we've talked about it before on the show, but it's always a good reminder that when it comes to capital, it's not the cost that we really should be fixated on. It's the availability.
The availability.
For what you just said, you know, maybe you got, $5 million to work with at 7%, no points. That's great. And then maybe that'll get you 10 deals in your market. But what about when the 11th deal comes?
So you want to be ready for it. Another way I just thought of to track down potential hard money lenders is when in your local marketplace, if you see fixers selling to, other investors, or other people, you can track down and you can look at the records, right? You go to the tax assessor's office or go to the recorder's office, and you can look at what paperwork or what's recorded against that property, and that name that has a loan against the property could be a potential hard money lender. So that's just another way to look at. Let's say you write an offer on a property, you don't get it accepted, someone else buys it, it's a fixer. You go to the recorder's office because it's public record, and you find out who recorded a loan against that who financed that deal. and there's a potential hard money lender.
That's brilliant, actually.
Yeah.
Just thought of that, huh?
Mm-hmm.
Nice.
Yeah. So that's another way to put into your bucket of ways that you find hard money lenders. And I will reiterate again what you just said is like, even if you're sitting here listening and watching saying, oh, well, I've got great lenders right now.
Yeah.
It's still a great time to look for other sources of capital.
Yeah. 100%. And there is a lot of capital. We were a few weeks back, maybe a little more than a month ago now, we were at the Equity Street Investors Conference. And I remember Jeff Rosenberg, owner of Big V Properties, $2 billion in assets under management. He was saying that we have about $1.5 trillion right now sitting on the sidelines waiting to get into real estate.
Yeah.
So they're out there. There's more money right now circulating our economy than any other time we've been alive.
Yep.
And
I agree.
We just need to learn how to get that funneling into our hands, But we got to find the deals, though. The deals are always the key piece there. So asset-based lending.
Yes.
They're going to check you out personally, like they did myself. I just my story. Now on paper, I was a hot mess. So I was riskier than you're somebody with perfect credit. So they dinged me with maybe a couple extra points or two, a little more interest.
Yes.
But the bottom line was I was still able to secure the loan. So why don't we run through in your mind like typical terms investors would expect when dealing and unpack points and
so if
percentage rate.
If you're a more riskier borrower like you were when you started out because you'd been through a bankruptcy, some financial situations that had led up to that point, weren't the stars didn't align for you at that time. The lender's going to look at you a little differently and the asset a little differently. They're going to probably want a little bit lower loan to value.
There you go.
Right. So they're going to assess the value of the property with either a desktop or a drive-by or full appraisal. What's the value of the property? And then they're going to lend a certain percentage of that value. If you're riskier, because of your personal finances or the deals maybe a little thinner, if you will, in terms of the profit potential, they're going to want to lower the amount of money that they'll loan in relationship to the value of the property. Gotcha. Now that scale slides up if you've got more experience, if you've got more assets, if you've got more money in the bank, they might be willing to lend a higher loan to value. So that's the first thing. They're going to assess the value, and then they're going to determine within the deal and you as a borrower how much money they're going to lend in relationship to the value of the property.
And I think an important note just to drop in there, when they're looking at loan to value, they're looking at the after repair value.
Yeah.
Like, so, after it's fixed up, if it's worth $200,000, maybe they lend 80% on that. So 160 would be their.
Correct.
That's what you're saying.
That's a good question to ask though, because some lenders, hard money lenders, will lend off of the after repair value, what it's worth when it's done, or they might lend off of the actual current market value. So that's repairs, So that's a good question to ask. How do they lend loan to value? Is it off of the future value when it's done, or is it off of the current value?
Yeah, and that just when it comes to hard money lenders, I mean, JD and I are giving you our experience and people that we work with, but hard money lenders are all in business to loan money and to turn capital. But they set the rules that they're comfortable with, right?
Correct.
So, what JD and I are giving you not necessarily is going to apply to everyone, but we're giving you the questions, to ask.
Yep.
So there will be a loan to value, whether it's off of future value, whether it's existing. Some will cover rehab costs, some won't.
Yes.
Some will, issue that money for rehab up front. Some will, do it draw schedules, type of thing. But why don't we start with points?
Sure.
So what is a point? How many in today's market should we expect when dealing with a hard money lender?
So point is 1% of the is 1% of a number, right? So if I say that I'm charging you, Jeff, 1 point on the loan, right? Whatever I'm lending you on top of that loan, right? We're going to charge you one point, and that's just a cost to do the deal, right? To get the money. So if we look at points, I can tell you when we started out, the rate at that time was 5 points.
I remember that.
5% just right off the bat, we were paying to the hard money lender, whether it was Sunrise Financial or some of the other lenders that were used. That's changed because money's become more competitive. So I think when you're looking at points for the money that you're borrowing, you can be looking somewhere between, again, every lender's different, as you just said, somewhere between maybe a half a point on up to maybe 2 points.
Yep.
Would be what I've seen and what I've heard sort of the going rate is. Now that will vary depending on your financials, the deal, how good the deal is, if it's a thinner deal. So somewhere between a half a point on up to 2 points is what I've seen to be sort of the going rate for points in a lot of marketplaces.
Yeah, and just like we were talking earlier, if you don't have a lot of experience, if you kind of have a sketchy financial situation, you may get hit with some higher points, higher interest. But on the flip side, could be rewarded for experience. I actually was at breakfast with a hard money lender this morning, and his thing is 2 points, 7.99% for a brand new investor.
Okay.
If you've done 5 deals over the last 12 months, then he drops it to a point.
There you go.
So you're rewarded 1.7.99%. That's kind of 0.5% is good though. I haven't seen that much myself lately.
Yeah, I think really that's going to come into play when you have more experience and you're maybe doing more volume. But you're probably not going to start out at a half a point, just like the lender that you referred to, that you met with this morning. Yeah. So then you also have, as you said, interest, and that's an additional cost of the money that you're borrowing, and so that usually is determined on an annual basis, right? So it's annualized.
Simple interest.
Yep, simple interest on an annual basis. And then one thing you want to ask the lender is, do they roll the cost of the money, the points, and the interest into the loan, or are they going to require you to make, for example, monthly payments on the interest?
Sure.
So that's a very important thing to know up front.
Yeah.
Interest, with regards to what I've seen to be going rates out there, you just mentioned that for that particular lender that you met with, they charge, you said 7.99%.
Yep.
Okay, so I was going to say the rates that I've seen are somewhere between 6% on the very low side for someone that is experienced, has strong financials, on up to maybe 10 or 11%. I've seen it hover for most people, whether you're starting out, somewhere around that 7 to 8%, like you mentioned that lender shared this morning. So those are good rates to look at obtaining. Yeah. And they're not as low as like a 30-year fixed type loan, but again, this is a different type of loan. Yeah. It's riskier. It's asset based more so than your financials. I mean, you are going to provide financial statements and et cetera, but they're not going through a financial enema like they do when you get a long-term fixed rate interest loan
or a VA loan. Gosh, that was horrible.
Yeah, but you can get what on that VA loan that you just completed. What was your interest rate that you got for that loan?
2.39.
Yeah. So it's worth a little bit of the financial audit that they make you go through for that low rate. So, it's a little, terms aren't as strict in terms of what they're going to require seeing, but the rate's a little bit higher.
Yeah.
So
100%. So we have points as JD, unpacked, and 1.1% of whatever you're borrowing. So half point to 2 points is common, 6%. Simple interest. And I know like when the first hard money loan that I did, I literally didn't have the ability to make monthly payments, so that wasn't an option. So that was a big question on my list, and a lot of hard money lenders will be okay with that, where they just aggregate what you would be paying monthly. Yeah. Then when the property closes, they collect their points, they collect their interest, or some take the points up front.
Exactly. So that's an important question to ask, as we've mentioned, is are they going to take their points up front, which they probably will. Most lenders do that, and then are they going to require monthly interest payments, or they're going to allow you to pay all that interest at the end of the loan along with the principal when the property sells?
Correct.
And that's another big advantage, I think, to hard money lending is, like you said, you didn't have the ability to make those interest payments.
Exactly.
And so that the lenders will look at that differently and allow you to still borrow the money, but they're going to get their interest when the property sells.
Exactly. Yeah. 5 points, 13 points. The deal we did together, the episode of Flip This House.
Saddle Ridge Road?
Yeah, Saddle Ridge Road.
Yeah.
I think we may have used Sunrise on that deal, but I remember you being 5 points and 13.99%. And I just remember an uncle, he's like, "Are you freaking nuts? So you lost your mind?" But it goes back to, again, cost versus availability. I mean, we paid maybe, I don't know, 20 grand in points, but
somewhere right around there.
I mean, we made a lot of money on that deal.
Yeah,
so
multiple six figures on that one transaction.
Yeah, so that is a beautiful thing. So we have the LTV, we have the monthly payments, we have the points, we have the interest. One thing I remember as a new investor that I actually really liked was when you approach these hard money lenders and you say, "Hey, I got this great deal." the ARV is 200,000, 50 grand in repairs. You know, I need this much money.
Yeah.
No hard money lender is gonna, you know, trust your numbers,
Yeah.
or just take them at face value. You know, they're gonna be, oh, well, that's great, but let us send, like you said earlier, they're gonna send
due diligence.
Yeah, they're gonna do their own due diligence,
Yeah.
which primarily consists of a future value appraisal. You know, basically confirming your ARV, and then a contractor, you know, reviewing the repair cost,
verifying repair costs
Yeah.
that you're estimating.
And I personally, as a new investor, I kind of like felt that, you know, I found that comforting in a way that, you know, if they came back and basically said, we're not loaning you the money because you said you could sell for 200, we see it at 150, then it's probably a deal I shouldn't be doing, or
another
something
set of eyes.
Yeah, exactly. Something I missed. So that's something that just expect when you link up with a hard money lender after you build the relationship and you send that initial deal. They will be doing a future value appraisal. They will be sending a contractor or somebody that works for them to give them their estimate of repairs. And if the deal checks out with them, that probably means you got a, you know, a good deal there.
Yeah, it can make you feel more confident. So I think that's a good point to mention, that it's very important when you're finding, interviewing, looking for hard money lenders, that you understand their process. What are they going to require up front? To get the loan, you know, approved, or to start the approval process, and then also what's their typical time frame to approve and fund the loan, because that's going
key, right?
That's going to be something that you need to know so you can appropriately write your offer in terms of closing time frame and contingencies. So that's a very important thing to know up front. What do they require? What's their checklist of things that they need to see from you to start the approval process, and then how long will it take them to, you know, approve the loan and fund it, so that you can use that when you're writing offers and meet your obligations. Write strong offers, but meet your obligations in the closing time frame.
Yeah, that's key. You know, we did an episode not too long ago where JD shared, you know, 2021, I've said this a few times, CT Home's most profitable year, company's history, 121 deals, you know, all of that. But you actually gave tips, you know, 8 different things on how you're doing that. I encourage you, if you haven't seen that episode,
Great show.
You know, go check it out. But one of the things that you discovered is when you write offers, you know, you're putting as a closing date 9 to 90 days, seller's choice.
That's what we do.
Yeah, and in the episode, he unpacks exactly why they're doing that. But I bring that up to say, you know, if you need to know how quickly can you do 9 days, right? You know, can you do 14? And that's going to come from you identify that relationship with the hard money lender, you walk through the process. So
get pre-approved, if you will.
Yeah.
You know, and I think it's also important, which is another reason just to go out there and search other hard money lenders, you know, add to your database so you can get pre-approved with more, and then use that timetable to write into your offers. But a lot of lenders' ability to fund fast or to approve fast will also be dependent on how organized we are as the investor. So are you using things like a deal analyzer like we have within our curriculum? Are you using a repair estimator that breaks down the repair costs? Are you organized in your own business so when you go analyze a deal, you can package up that due diligence package and just fire it right off to the lender?
Yeah. No, that's huge. I mean, due diligence package. I mean, the tools that you just mentioned,
Comps.
the deal, comp package, right? We have a tool we use. It's called the deal analyzer, but it analyzes the deal. It also accounts for the repair costs, the comps, and then it basically aggregates all that data into an investment summary.
Yes.
And that investment summary is typically what you'll put in front of the lenders. You put, you know, and it basically just high level, everything they need to know about the deal. And when you walk in, especially if you're new and you walk in, it just brings a higher level of credibility. You know, you're not walking in there looking for them to guide you like you don't know what the heck you're doing.
They can do their job easier as the lender in asking, okay, I need a little more detail here, or I need this or that, but you've given them the majority of what they need to see to start the approval process and give you a quick decision.
Yeah. And, you know, another great benefit of hard money lenders is when we've talked a lot about on the show finding deals in many different ways, off market, on market. There's pros and cons to both. But on market, working with agents, which CT Homes does a lot just because you have such an outstanding reputation here, is, you know, agents are going to require proof of funds. You know, so that's something that we can acquire through a hard money lender where we want to position our offers as investors as cash offers. And through a proof of funds letter from a hard money lender, we're able to do that. Why don't you talk around that for a minute? Yeah.
So some sellers, whether it's, you know, directly from the homeowner or working through agents, will want, you know, to see your ability as the buyer to, you know, actually get the deal done, whether it's a pre-approval letter from a lender, hard money lender, or a statement from your bank account or savings account showing that you have the money there. So when you have already gotten pre-approved, if you will, from a hard money lender, like you just said, many will give a letter to you saying, that the cash isn't in your bank, but you've been approved for loans up to this amount.
Yes.
And so by having that, it can substitute in, and it can be your proof of funds letter to show the seller, the agent, et cetera, that you have the ability to buy the property. So that is very valuable. And, there's a lot of conversations I'll have, and you probably do as well, boot camps and things, well, how do I write a competitive, strong cash offer, quick close if I'm still borrowing money? And I understand the question. What a seller wants to know is that the insurance that you're actually, going to close on the property and have the ability to do that. Whether someone has the cash sitting in the bank or they're borrowing money from some other place, as long as you can show the seller or the agent that you're qualified, you have the ability to close, give them that assurance, they function as the same thing. So, and for the most part. And also I tell investors, don't not write offers on properties just because you don't have a proof of funds letter yet. Let them ask you for that, because some sellers don't. And you're talking yourself out of even writing an offer because you don't have a proof of funds letter yet. And when they ask for one, then you provide one, which is another reason to get pre-approved with hard money lenders.
Yeah, 100%. I mean, I've talked many times just about off market, where you're getting directly with the seller. I think in my, in the past 16 years, I've had 2 sellers ever ask me for a proof of funds. So it's definitely getting to off-market properties is something we really encourage.
Yeah.
And, you're not going to need the proof of funds there as much. On market, a little bit of a different animal.
Probably more so they're going to require or ask for that.
Yeah. And I found too, I remember in the early days, maybe like 1 out of every 4 offers with real estate agents, they would kick it back and say, hey, this isn't a cash offer. You're getting a hard money loan.
Yeah.
And they would ask me to, reposition my offer as financing, which you just do that, if that's what they ask.
You can also write it in what we do in our offers, because we at CT Homes borrow money to do our transactions. So when we write in cash offer, we substitute in or write in conjunction with that, buyer, which is us in this case when we're writing the offer, entertains the right to bring in a loan as long as it doesn't affect the closing time frame. So we'll write that into the offer, whether it's cash or borrowing money, as long as it doesn't change the terms of our offer. So we're giving the seller, telling the seller, look, we're going to close on this time frame that we're offering. We might use cash, or we might our own cash, or we might use someone else's cash.
Yeah, I've never done that before. So actually in the contract, in the like where it says type of financing, you're checking cash and then just adding that note there.
And then writing into the notes somewhere in the contract where there's a note section, seller or buyer entertains the right to introduce private financing, or in our case, bank financing, because we do borrow money from banks. And then we write in as well, not to affect the terms, the closing terms of the contract.
Sure.
So it's us telling the seller, look, we're going to bring money to close the transaction. Might come from a couple of different sources, but it's not going to affect our, in this case, 9-day close or 90-day close, whatever you choose.
Excellent. That's a great tip. I want to get into just the security and what's going to be, the hard money lenders are going to be looking for us in order to actually, give the loan. Before I jump into that though, is we're talking a lot about understanding how to raise hard money, capital, all of that, which is important. But I don't care how much money we raise, how good we are at it. None of it matters unless we're able to find discounted properties.
Very true.
That we could get under contract, that makes sense. So we actually every week we have a brand new training. It occurs every Thursday, and it's very simply how to find and acquire real estate. And really, what we get into there is exactly how CT Homes, how Dan, Paul, and Conrad are able to consistently week after week. We're in a 30,000 square foot commercial building in the lower level. Right above us is JD's office. You walk into that office any given time, there's 20 to 40 deals happening consistently, as long as I can remember, And so really this training is how to help investors like yourself consistently find discounted properties. We get into even some what we call hidden markets, how to access, niche lists, to just give us some valuable data that's out there. I actually am one of the trainers. I love to do that. We have a couple other trainers that do a great job. But if you're interested in that, finding deals and how to acquire them. Right below this video, YouTube channel, Facebook Live, click the link that says fortunebuildershow.com. Obviously, if you're listening through an audio platform, just type that into your URL, fortunebuildershow.com.
A lot of people ask, it's an amazing training. You're right. A lot of people ask, well, what do you find the deal first or do you find the money?
Oh, yeah.
You find the money first or do you find the deal? The reality is you're always looking for both. But you don't have anything to fund, obviously, until you find the properties.
Yeah.
So amongst other things, that's where that class will really help is, having other places, finding new places and to source deals so that you have something to fund.
Yeah, I know I've made this point already, but just to dig it a little deeper, gun to your head, JD, you could only have $1 million to go buy a property or a motivated seller that you could get a property under. Which one are you taking?
$1 million or a motivated seller. Man.
So you could take away one worry, finding deals or finding the money. What would you prioritize?
I'd prioritize finding the deals.
Yeah, I would too. I would too. Just because, like I said earlier, if you lock up a good deal, then you
find the money.
You could scramble to find the money, and if it's a good deal, people are going to start throwing it at you.
100%.
Excellent. So let's fast forward to the point we found a deal.
Yeah.
We submitted it to a hard money lender. We agreed on the terms, the points, the interest, the loan to value, all of that. The hard money lender does their due diligence.
They're good to go.
They're a go. So what documents? How do we actually give them legal security on the property?
Yeah, well, each lender will have their own protocols and paperwork, but in a general sense, what they're going to require are you to sign a promissory note, which is your, as the borrower's promise to pay them back based off of the terms that, have been agreed to.
Yep.
On top of that, they're going to secure a deed they're going to record a deed against the property for the amount of money that you're borrowing.
Yep.
Additionally, they're also going to require, before they fund the loan, that you have insurance in place and that you add them to the insurance policy in the way that they need that done. Certain wording, certain verbiage, a certain name that they need in there as an additional, insured on the policy. So those are the three main. Now it's not going to be 3 pieces of paper. It's going to be a lot more paper than that. But those, in essence, what that paperwork boils down to is they're going to record a deed against the property. They're going to have a promissory note that you'll sign, and then which are the terms of the deal, and then they're going to require you to add them on the insurance. Yeah. So those are the main things, and that's also good to know up front, maybe get copies of ahead of time as you're getting pre-approved, just so you can understand what's there. That anytime you sign anything, you want to read through it and know what you're signing, what's in there, what's not in there, what you're putting, because you're borrowing money, but some require a personal guarantee as well.
That's true.
Which is you now it's not just the asset or the property that secures the loan. It's you also personally guaranteeing through your financials, paying the loan back. Many hard money lenders don't require that, but some do. So that's good to know up front too.
Yeah, and I think we'd all prefer rather not to sign a personal guarantee, but to me I've signed one many times. I'm sure you had as well. And I mean the bottom line is you don't ever borrow money you don't intend on paying back.
Exactly.
So if you have to sign it, it's not the end of the world. I'm not going to offer it, but that is a good thing, and that goes back to what we opened the show with the asset-based lending. So that mortgage deed that JD was just referring to gives them a lien position on the property.
It's their main security.
Yeah, it's their main security, and that's what you mentioned it also in the beginning, where if I fast forward to that deal I did when I was 27, if I was on a risk I was paper. The deal turned out great, but let's just say it didn't, and I screwed it up. Then they were going to step in. They would foreclose on the property. They would take the ownership. They would finish the project, and they would actually end up making more money on the deal because they make the interest plus what I was supposed to make.
That was in the deal. I think it's also good to, maybe you're going to bring it up to talk about how after the loan's funded, how would a draw process work if someone's borrowing construction money, rehab money. Talk a little bit about that too, which you may be getting to, but I think it's just good that we touch on that before we wrap up the show.
I think so too. And just going back to the LTV, right, loan to value, right, where very few hard money lenders. There was a time where it was a little more common. I haven't seen many today, but very few will fund 100% of what you need to do the total
Yeah,
transaction.
they're going to want you to have some skin in the game.
Yeah, they want you to have some skin in the game. But the good news is it doesn't have to be your skin.
Yeah.
Right. I mean,
True.
I would say probably best case, you could correct me if you're seeing something different, but maybe 80% of the deal we could get covered by hard money.
Yeah, maybe up to 80% in some cases.
Mm-hmm.
But yeah, that's about for most of us, that's where we're going to find the maximum loan to value that we're going to be able to borrow.
Yeah, so that may cover. I mean, we're going to need to bring some more money to the table. So again, but it doesn't have to be our skin.
Mm-hmm.
So it could be private money. Maybe let's just keep numbers simple. You need $100,000 to do a deal. A hard money lender covers $80,000.
Mm-hmm.
We need to raise 20, right?
Yeah.
Private money lenders, credit cards.
Yep.
Lines of credit. I mean, so many different ways.
We used credit cards on some of our first deals for that.
Yeah.
That amount of money that we needed to put down on the deal.
Yeah, and you often refer that here to as gap
Yes.
funding, right?
Yes,
like I have a 20% gap. I need to fill that with a
good
credit
term
card.
for people to understand if they haven't heard it before. That is what that difference is. It's that gap funding.
Yeah, exactly. But yeah, let's get to the draw schedule because that's important. So say we have a hard money lender, they're covering 80% of our acquisition and 100% of the rehab.
Okay.
We have an $80,000 rehab we need to do.
Yeah.
Right. So there are some hard money lenders that when you close the loan, they'll just give you that $80,000. It goes in your business bank account, easy peasy, right?
Yeah, very few.
Very few.
But there are some.
Yeah, but what you'll find more typical is they want to do a draw schedule.
Mm-hmm.
You complete this amount of work, we issue that. So talk through your thoughts on that.
Yeah, so if you're borrowing money for the rehab and the construction, like Jeff mentioned, most of the time they're going to release that money over a series of draws. So before the loan is funded, will have laid out the construction schedule, in a general sense or as accurate as you can at that point, what's going to get done when, and then the lender will apply different amounts of money that they'll release at that time. So what happens is once you start the construction,
right,
week one is done, you say, hey, Mr. or Mrs. Bank, I'm ready for my first draw on the construction loan.
Right.
The bank will send someone, or the lender will send someone out to verify that the work has been done as you said it has. And then once that gets verified, then they'll release money to cover that amount in the form of a draw. And that's, generally how a draw schedule works. It's very important to know up front what that timing looks like. Does the lender do that quickly? Does the lender not do that quickly?
Very important, yeah.
Because if you don't know that and you're promising a contractor that at the end of the week when they finish these things, they're going to get paid, but in actuality, that's going to take 5, 6, 7, 14 days.
Yeah, it could
after
be an issue.
It could be a big issue.
Yeah.
So you want to know that going in, and then you're going to set your relationship with the contractor and your ability to pay them against, so it correlates with that draw schedule.
Yeah, that's huge. I mean, if you're a Fortune Builder student, you're using the payment schedule. You're setting this up ahead of time with your contractor. You're setting up the draws for the contractor, right?
Mm-hmm.
So in week one, they do the roof, windows, whatever. But like JD said, if you're working with hard money on a draw schedule, you wanna line up your contractor's payment schedule with that draw schedule.
Yes.
And bring them in alignment, because then they know, okay, well, if this gets done by Friday, the contractor saying I'm getting paid.
And a lot of ways it takes pressure off us as the investor, because now it's not us dictating the draw schedule, it's the lender.
Yep.
So you can kind of use that when you're negotiating with the contractor. So, to set up that draw schedule, like you just said. The other thing that's good to remind ourselves, or if you haven't heard this before, a lot of lenders will only have a certain amount of draws that they'll release over a given time period. For example, it's usually not weekly. They'll have like one draw or two draws that you're able to pull on in, let's say, a 30-day period. That's going to be some of the details of the draw schedule that you want to find out ahead of time too. Is there a minimum or a maximum amount of times you can pull on that money over the course of a month, as an example? Yeah,
no, that's good. Like we said, every hard money lenders, I mean, they're going to create and dictate the rules, for their business and how they run. But most of them will do a draw schedule, and the key is getting the contractor aligned with that. Because then also too, city inspections may be required, and the contractor will coordinate those to, get done at certain times,
Exactly.
leading up to the payments being released. So, hey, what did we miss, JD? So we went through the asset-based lending concept, the common terms, the security, the draw schedule. Any other thoughts you want to
And
share?
those are the main things. I think we'll kind of finish up with what it looks like when we go to sell the property and
Yeah.
just kind of book in what happens and the loan gets paid back. So normally, we know when we borrow the money at the front end, when we buy the property, that loan will happen and get funded through either escrow or attorneys, obviously,
Yeah.
depending on how you're closing. And then that same thing happens on the back end when you go to sell
Sure.
the property. So the lender who you borrow the money from will issue a demand statement, which is basically them telling the escrow or the attorney how much money that they're
Yep.
due back. So it's a payoff demand, it's basically what it's called. So that's something that the lender will generate that gets to the closing agent or the escrow, depending on how you're closing properties. And then in your closing statement, that'll get prorated and taken out. So when you close on the property, you're not getting that money and paying the lender back.
Right.
It's getting paid directly through the
Directly
closing
to them.
process.
And typically they're getting paid first. And one thing
Yes.
we didn't mention is I'd say, give me your opinion, but 99% of hard money lenders out there are only going to loan in the first position.
That's very
Yeah.
true, and we haven't talked about that yet. So you're right. First position is where a hard money lender is going to be. They're not going to let you bring Uncle Joe's money in first position and they're in second position.
Yeah.
Basically, because anything behind first position is a riskier
Yeah. proposition
for a lender.
Yeah.
So you're right. They're going to be in the first position on the recorded paperwork, and that's 99.9% of the time what they're going to require.
Yeah, 100%, 100%. Yeah, and then you close the deal, they get paid first, and then you got your first deal in the books there, and then they're going to be on you to get that money out there working again. When's the next deal coming?
Yeah, that's the good thing, right? You turn someone's money around, make them money, and then they're going to be asking you, "Hey, Jeff, when's the next opportunity you have for us to lend some money on?"
Yeah, 100%. But like I said, even if you're listening to the show and you have some private money lined up, some lines of credit, whatever, I don't want to pay higher interest rates. Still find those, develop those relationships. I remember when I was exclusively wholesaling, you guys taught me this is, hard money lenders have a database of investors.
Mm-hmm.
And, so I would bring my wholesale deals to them and ask them, hey, can you put this to your list? And they would do it for free.
Yeah.
Because if somebody on their list bought it from me, that's a chance for them,
It's a new loan for
to
them.
lend money. So they tend to be very well connected in the investor community. So there's a lot of benefits that could come from just knowing with them and working with them outside of the money. Oh, so I said at the beginning of the show, we actually learned, we learned some new definitions. It was funny. We've been doing this for, you longer than me, but maybe 15, 16 years. And right before the camera went on, we're like, what does hard mean? Like,
where did it originate from?
Where did it originate?
Yeah.
Yeah. I mean, I always, my mind went to like the hard asset, type of thing. So we did a little Google search.
These are interesting.
And we might need to debate Google, but one right here says hard money loans are essentially a type of asset-based financing in which the borrower acquires the funds that are secured by real property. So I'm vibing with that so far.
I agree with that.
But then it goes on here and it says it's called hard money loan because it's harder to acquire and pay back than some of its soft money counterparts.
Yeah.
I'm not sure I agree with that.
On the real estate side, I would not agree with that. Maybe gold, silver, something like that. I mean, that definition may apply, but I think it's easier to acquire in a lot of ways for the reasons we talked about, because it's based on the asset. And, frankly, from my standpoint as a borrower, it's actually easier to pay back as well.
Oh, easily. Yeah. I mean, if you could find the deals, I mean, to me, the money is the easiest part. We also learned that hard money, if you contribute directly to a political candidate, that's hard money donation. But if you contribute just to the political party, that's a soft money donation. Okay. So hey, we're learning
that
here
I've
too.
Never heard before.
Yeah,
either.
I've never heard that. But the bottom line is, as investors, we love hard money. We want to develop the relationships. We want to get it in place. And again, it's not the cost of the capital that's important. It's the availability. So it goes back to, would you rather have, a little bit of something than 100% of nothing, right?
100%.
Is what it comes down to. And I don't care how big you are, how long you've been doing this, once you know how to acquire assets, that's why this training, I'm so excited about this new training we do, because it's really dialed in on how to find assets. And it's kind of like when you research a new car. I know you're a car guy, you buy a lot of cars, right? And did you ever notice, like, you research a car, you're designing it online, checking it out, then you drive around town, and all of a sudden you feel like it's all you see, right? It's the same thing. Once you understand how to acquire real estate, like, I don't care if you go on vacation,
it's true.
You just quickly identify stuff. So you want to have as much capital, as many different types available at all times. But man, great having you with us again, JD. Any parting words?
No, I would just reiterate what we've said a few times. It's not the cost of capital, it's the availability. If you're listening or watching and already have great sources of capital, congratulations. But there's always others out there. And it's never a bad time to find more capital.
Never a bad time.
And never a bad time, because when that next deal comes up, if you got the capital, boom, it's there. You're off and running.
Let's go. So if you listen to today's show, now homework is go find a hard money lender. Find a local one, find a national one, pick up the phone, understand what their terms are, get that proof of funds going. And if you currently have a hard money lender in place, find another one. Find another one. And let's get out there. Let's find some deals. And thank you so much for being on today's show. Continue to share us with, friends and family members. We want to reach as many people in this country with financial education, just because we understand the power that it has to change lives. So we appreciate you doing that. Continue to interact with us on social media.
Absolutely, yeah.
Let us know what you want to hear more of, or some maybe guests you want us to bring in. We'd be happy to do that. But we will see you next week. Same time, same channel. Fortune Builders Real Estate Investing Show. Take care.